The screen price is the decoy, because the real stress signal in gold and silver is in the headline move. It's the forced flow hitting thin liquidity right now, and you can watch it in real time if you know where to look. It's a narrative machine trying to pin this entire move on emotion and speculation, because that story is comfortable, it's dismissive, and it gives people permission to ignore what's actually happening under the hood. But the hidden mechanism that matters this week isn't a headline at all. It's a calendar event. It's mechanical. It's price insensitive. And if metals absorb it without breaking key levels, the market is telling you something louder than any pundit can. Because here's the uncomfortable truth. When a market is truly fragile, it doesn't need bad news to drop. It drops on flow. And when a market is truly strong, it doesn't need good news to climb. It climbs through selling. That's the tell. That's where the real pressure starts. You've probably felt it already. One moment gold looks steady, the next it lurches, fast, like liquidity just thinned out. Silver does it even more violently. It's not the smooth, dignified store of value tape people expect. It's sharp. It's mean. It's designed to make you second guess. And that's exactly why this moment matters, because volatility is not just a byproduct here, it's a weapon. And if you don't know who's forced to trade this week, you'll mistake the weapon for the trend. Let's set the context without turning this into a history lecture. Big picture. Gold and silver have already had a regime-style year recently. Moves that don't just change price, they change behavior. When metals run that hard, everyone who manages risk has to adjust. Funds rebalance, dealers widen spreads, risk managers tighten limits, and people who were late or underweight start chasing at the worst moments. That's the backdrop. And right now, the market is trying to decide whether that regime continues or whether it resets with a painful shakeout. But the next detail is what flips the whole setup. Because the why now is not mystical. It's a calendar trigger. And the calendar doesn't care about your feelings. This week, one of the quietest but most powerful forces in commodities tends to show up. Annual commodity index rebalancing. That sounds boring. It's not. It is one of those institutional mechanisms that can create selling or buying pressure that has nothing to do with a new inflation report or a central bank speech. It's the financial equivalent of gravity. Big pools of money track commodity indexes. Those indexes change weights. Funds that must match those weights are forced to trade on schedule. Not because they think gold is expensive, not because they think silver is cheap, because the rules say so. And when that forced trading collides with thin liquidity, early January, post-holiday positioning, managers resetting exposure, people still waking up to a new year, you get a market that can whip around even if the underlying bid is strong. That's the part most retail investors miss. They watch the candle, they don't watch the plumbing. But the plumbing is where price discovery gets distorted. Here's how it works in plain language. An index rebalance can require certain funds to sell one commodity and buy another to keep their portfolio aligned with the benchmark. Often, the trading expresses itself through futures, because futures are liquid, standardized, and operationally easy. Futures trading hits the order book with size. It can push price down quickly, especially if the book is thin. It can also trigger algorithmic momentum signals, stop orders, dealer hedging adjustments, basically a cascade of if-then behaviors that move price farther than the original flow would justify. And then, this is key, once that forced flow is done, the market is left with the real underlying supply demand again. If the real bid is there, price snaps back hard. If it's not, price keeps bleeding. So the question this week isn't just are gold and silver up? The question is, what happens when an indifferent seller shows up? Because if metals hold their ground while someone is forced to sell, that's not weakness. That's strength wearing a disguise, and that's where the market can't unsee it. Now, let's talk price context without pretending we have a crystal ball. Recently, gold has been trading in a range that's high enough to make people nervous and tight enough to make the next break meaningful. If you've been watching the tape, you've seen gold press into the mid-4000s and then react, sometimes sharply, around those levels. Silver, meanwhile, has been swinging in a way that screams positioning. It has traded through the 70s with violent bursts, tagged higher levels, and snapped back. That's not a calm market. That's a market in negotiation. But here is the mistake. People see that volatility and assume it means the thesis is broken. No. Volatility often increases when a market is transitioning from one regime to another because different participants are trying to control the same instrument for different reasons. Some are hedging, some are rebalancing, some are chasing momentum, some are short and stressed, some are long and taking profit. The tape is the battlefield, but the battlefield doesn't tell you who wins. The supply lines do. And one of those supply lines is institutional flow. Let's stack proof the way professionals do, not the way clickbait does. Not one argument. Layers, mechanism, data, behavior, symptoms, cross-market signals, and then a roadmap. First layer, central banks. Central banks are not day traders. They don't care about your 4-hour chart. When they buy for reserve policy, diversification, and quietly, risk management. And over recent quarters, the official sector has remained a meaningful source of demand in gold, even as the narrative swings from inflation hedge to safe haven to bubble. That matters because central bank demand tends to be sticky. It doesn't vanish because price dips 3% on a Tuesday. So when you see gold wobble under mechanical selling pressure and then find a bid, one question is always, is that bid consistent with the kind of demand that doesn't T-flinch? Because if it is, short-term volatility becomes less meaningful than most people think. But that's not the only layer. Second layer, institutional forecasting behavior. When major institutions publish targets or updated outlooks, the point isn't that they're always right. The point is that they're reflecting what their client base is discussing, what flows they're seeing, and how risk models are shifting. In metals, those published views often widen the public's imagination of what's plausible. If people spent years anchored to a lower price regime and now the conversation includes meaningfully higher levels, that can change positioning behavior. It can turn sell rallies into buy dips, at least for a period, and that shift changes the tape. The next detail is what flips the whole setup. If the market starts treating pullbacks as inventory restocking opportunities instead of get out before it collapses, the downside becomes harder than it looks. Third layer, ETF plumbing. ETFs look like a ticker. They are not just a ticker. They can reflect broad investor demand and sometimes translate into physical demand through the creation and redemption mechanism, depending on the product structure and market conditions. Now, I'm not going to tell you ETFs are the whole story. They're not. But they do matter because they rear one of the easiest pipelines for large numbers of investors to add exposure quickly. When that pipeline turns on, it can tighten the ecosystem. Authorized participants source metal, hedges shift, and the market's sensitivity to supply interruptions can rise. And when volatility hits, ETF behavior can amplify moves both ways. That's why you don't just watch price. You watch whether the ecosystem looks like it's tightening or loosening. And that's where the real pressure starts. Fourth layer, silver supply chain reality. Silver is a different beast. People treat it like a leveraged gold play. Sometimes it behaves that way. But structurally, silver is also an industrial metal with demand drivers that Donati politely wait for your macro thesis to be confirmed. It's used across industries, including energy-related applications like solar, and the supply side is stubborn. Much of silver supply comes as a byproduct of mining other metals. That means silver supply doesn't ramp up quickly just because silver price spikes. The lead times, the capital cycles, the geology, none of that cares about your weekly candle. So if industrial demand remains resilient and supply response is constrained, you get a market where physical tightness can matter a lot, especially when investors pile on. That is how you get the kind of sudden runs and sudden air pockets that make silver feel like it's trying to throw you off its back. Because it is. Fifth layer, market structure. Term structure and the cost of carry. This is the part most people skip because it sounds technical. It's actually simple. Futures prices across different months form a curve. In many commodities, the curve shape tells you whether near-term supply is tight or whether storage is plentiful. Gold often trades with a carry because you have storage and financing costs. When rates are high, carry matters more. When the curve flattens, steepens, or behaves oddly, it can reflect changes in financing conditions, borrowing, demand for immediate delivery, or hedging pressure. You don't need to become a curve trader. You just need to understand what a stressed curve can imply. Participants are paying up, or being forced, to manage near-term exposure. That often shows up before price moves make sense to the public, because the curve is where the pros whisper. Price is where the crowd screams. Now put those layers together and look at the conflict. You have a market with strong structural narratives, official sector demand, shifting institutional regimes, potential constraints in silver as supply chain, and you have a near-term calendar flow that can dump futures volume into a thin market. That is the perfect recipe for confusion. And confusion is where weak hands get harvested. So let ES talk about the two scenarios you need in your head before the market tries to install panic in you. Scenario 1 is the controlled pullback and retest. This is the annoying but healthy path. Price sells off on flow. It breaks a few short-term supports. Everyone who bought late feels sick. Social media gets loud. Then price stabilizes near a major reference zone. You see buyers show up. You see the selling exhaust. Then the market retests. Maybe it tags that zone again. Maybe it dips slightly through it. And then it starts to grind higher. In that scenario, the pullback is not the story. The response is the story. The market is basically saying, we can't go down even with a reason. Well, that's bullish, even if it feels awful in the moment. Scenario 2 is the continuation squeeze and gap risk. This is the no one gets a clean entry path. Forced selling hits, but it doesn't push price down far. Buyers absorb it early. Then, once that mechanical flow is done, the market lifts. Shorts, who were leaning on the flow, get trapped. dealers adjust hedges, liquidity stays thin, price starts moving in jumps instead of steps, and that's when you get gaps, overnight, weekend, or during illiquid windows, where you look up and the market is simply somewhere else. That's when people chase, that's when mistakes compound, and that's where the real pressure starts. Both scenarios can happen with the same underlying thesis being right. That's critical. Even if the longer-term trend is up, the path can be violent, and the path is where most people lose. Not because the thesis was wrong, but because they were emotionally manipulated by noise. Now, let's get concrete. What levels matter? Not because levels are magical, but because levels are where forced participants are forced to act. If gold has been defending a zone around the low to mid 43 patrones in recent trading, that area becomes a line in the sand, a place where dip buyers have proven they exist. If that zone holds during flow-driven selling, you're watching strength. If it breaks cleanly and doesn't reclaim, then you have to respect the possibility that the market needs a deeper reset before the next leg. So you need the plan in advance. Here's the key. You don't just watch whether a level breaks, you watch how it breaks. Does it break on heavy volume and keep accelerating? Or does it break, stall, and then snap back? Does the market spend time below it, or does it reject lower prices quickly? Those are clues about whether the move is flow-driven liquidation or genuine trend change. The next detail is what flips the whole setup. Flow-driven moves often reverse faster than your emotions can. Now, let's go back to the hidden detail, the calendar. Index rebalancing isn't just one trade at one moment. It can influence the entire week's tone. Why? Because participants anticipate it. They front-run it. They hedge around it. Liquidity providers widen spreads because they know size is coming. That creates a self-fulfilling environment where even normal orders can move price more than usual. So if you were watching gold and silver this week and you see these sudden air pockets, you shouldn't immediately conclude something broke. You should first ask, is this the week where mechanical flows can exaggerate every move? Now let's bring in another mechanism that can amplify moves, positioning and margin pressure. In futures markets, leverage is a feature. It's also a trap. When price moves against leveraged positions, margin calls happen. Positions get reduced. That reduction can be mechanical. It can be forced. And forced selling doesn't wait for the perfect price. It hits bids wherever bids exist. That's why you can get these fast flushes in silver especially. A small move can trigger a bigger move because liquidation is reflexive. The market pushes, margin calls happen, selling increases, the market pushes more. Then, at some point, the selling runs out and price rebounds just as violently. People watching from the outside call it manipulation. Often it's just leverage doing what leverage does under stress. Incentives and structure create the behavior. That's finance. That's not a conspiracy. And understanding that distinction keeps you from making the worst kind of decision. The one based on a story that feels good instead of a mechanism that is real. So what should you actually watch over the next 1 to 2 weeks? Not 10 indicators. A short checklist. Because when everything is moving fast, too many signals becomes noise. First, watch whether gold holds and reclaims its key support zone after any flow-driven dip. If you see gold dip into that zone and then rapidly reclaim, that's a sign buyers are active and the selling is being absorbed. If gold breaks and then struggles to reclaim for multiple sessions, that's a warning that the market may need to reset deeper. Second, watch whether silver's pullbacks are being bought with urgency or with hesitation. Silver tells you about risk appetite inside the metals complex because it's the more emotional instrument. If silver stabilizes quickly after dips and starts building higher lows, it suggests the complex is internally strong. If silver starts making lower lows and bounces get weaker, that suggests liquidation pressure is dominating. Third, watch the shape of the moves. Are rallies grinding up in a controlled manner, or are they explosive bursts, followed by sharp retracements? Explosive bursts can be squeeze behavior, short covering, dealer hedging, thin liquidity. That can be bullish, but it also means volatility will be used against you. A grinding, controlled move suggests broader sponsorship, which can be more durable. Fourth, watch the macro throttle. Real rates expectations, dollar behavior, and risk sentiment. You don't need to trade them, but you need to know if they're turning into headwinds. A sudden dollar spike, a sharp repricing of rate expectations, or a broad risk-off liquidation can temporarily slam everything, including metals, even if the long-term thesis remains intact. That's where people get tricked. They think gold should be up and risk-off. Often it is, eventually. But first, leverage gets unwound. First, portfolios get de-risked. First, correlations go to 1, and that's where the real pressure starts. Fifth, watch for the tell after the calendar flow. This is the payoff. If the market survives the forced flow and then starts lifting, that's your confirmation that the underlying bid is not just talk, it's action. If the market gets pushed down by the flow and then can recover after the flow window passes, that's information too. It means the market may have been more fragile than the narrative admitted. Now, the part that protects you the viewer psychology shield, because the market is going to try to manipulate you with three emotions: fear, urgency, and regret. Fear shows up as the sudden red candle. It triggers the thought, I have to do something right now. Urgency shows up as the rebound. It triggers, I missed it, I have to chase. Regret shows up after you act emotionally. It triggers, I always do this wrong, maybe I should quit. That cycle is how portfolios get shredded even in a bull market. So here's the antidote. Separate trend signal from noise before the move happens. Trend signal is what persists through stress. Noise is what happens because liquidity is thin, because a calendar flow hits, because margin gets called. In a trend, the market can whip around violently and still be in trend. In noise, the market can look convincing for a day and still reverse. A simple discipline helps. Name your invalidation ahead of time. Not emotionally, mechanically. If price breaks this zone and fails to reclaim by X time window, the thesis is weaker. Or if price holds this zone through known forced selling, the thesis is stronger. That's not prediction. That's process. And process is what keeps you from being the liquidity for someone else's trade. Let's also talk about the paper versus physical tension without turning it into mythology. Futures markets set much of the reference price. That's not inherently sinister. It's how standardized markets work. But during periods of stress, the relationship between paper trading and physical sourcing can get strained. You might see it in premiums, in availability chatter, in procurement behavior, in the way industrial users lock supply. Not every anecdote is proof. But when multiple symptoms align, tightness narratives, robust bids after dips, curve behavior, sustained demand from sticky buyers, that's when you treat it as a mosaic, not a rumor. The next detail is what flips the whole setup. You don't need one perfect statistic to see a regime shift. You need consistent signals across multiple layers. So, what is the major shift underway? It's this. The market is transitioning from a world where gold and silver were primarily traded as opinions to a world where they were increasingly treated as allocations. Opinions are fickle, allocations are structured, allocations are embedded in policy and reserve strategy, in industrial procurement, in institutional mandates. And when allocations are the driver, pullbacks become events to manage, not reasons to abandon the asset. That changes the character of the market, but don't get hypnotized by the bullish case. Credibility means respecting counterpoints. Counterpoint 1, if real yields rise meaningfully and stay elevated, the opportunity cost of holding gold increases, and that can cool demand at the margin. Counterpoint 2, if the dollar strengthens sharply, it can pressure metals in the short term, especially if it coincides with broad deleveraging. Counterpoint 3, if speculative positioning gets too crowded, the market becomes vulnerable to violent flushes that feel like the thesis is dying, even if it asks just leverage clearing out. Counterpoint 4, if industrial demand in silver softens unexpectedly or supply disruptions resolve, the tightness narrative can lose urgency. These aren't reasons to panic, they're reasons to watch. Because the market pays you for being early and humble, not late and loud. And that's where the real pressure starts. Now, here's the near-term roadmap in plain terms. What to expect, what to watch, and what would change the story. In the next week, expect volatility spikes around liquidity windows. Expect the tape to look irrational at times because flow can be irrational relative to fundamentals. If gold dips toward its recent support zones and quickly reclaims them, treat that as a constructive retest. If gold breaks down and stays heavy for multiple sessions without reclaiming, respect the possibility of a deeper reset. On the upside, if gold takes out the upper end of its recent range and holds above it, that's a confirmation that buyers are not just defending, they're advancing. For silver, the same logic applies, but with more violence. Watch whether dips into the low 70s region are being defended. Watch whether silver can reclaim the mid to high 70s pivot area and build above it. If silver starts holding above that pivot and presses higher again, that's a sign the complex is tightening. If silver loses the pivot and bounces get weaker, it's telling you liquidation pressure is still in control. And here's the simple what confirms checklist. Higher lows after forced flow dips, quick reclaim of broken levels, reduced downside follow-through, and renewed upside momentum after the calendar window. What weakens? Checklist. Clean breakdowns with failed retests, rallies that get sold instantly, and broader risk-off shocks that force indiscriminate selling. Notice what I didn't say. I didn't say guaranteed. I didn't say can't lose. I didn't say this is the one trade, because that's not how real markets work. Real markets punish certainty. They reward preparation. One more thing, this matters more than people realize. The weekend gap risk. When liquidity is thin and positioning is stressed, weekends become catalysts even without new information. A headline can hit when futures are closed, or liquidity can reopen thin. That's how gaps happen. If you're watching gold and silver right now, don't underestimate how much the calendar itself can be the catalyst. Not just index rebalancing, month start flows, dealer positioning resets, options dynamics around key strikes, the calendar is the catalyst. And if you ignore it, you'll misread the movie. Now, let us bring it home with the one metric everyone should keep in their mental foreground: how price behaves during forced conditions. Anybody can look smart when the market is calm. The market reveals the truth when it's stressed. If you see gold and silver absorb forced flows, hold critical zones, and then lift when the mechanical pressure fades, that's the market telling you the bid is real. If you see those zones break and fail to reclaim after the pressure should have passed, that's the market telling you it needs to reset. That's the signal. Everything else is noise wrapped in drama. And here's your final guardrail. Volatility will be used against you. If you decide you're a long-term holder, you'll be tempted to react to short-term moves. If you decide you're a trader, you'll be tempted to turn every move into a prediction. Both paths can fail if you don't define your time horizon and your invalidation. The market will try to pull you into the middle, where you have the risk of a trader and the patience of a tourist. That's the danger zone. So pick your frame. Are you watching this for a 1 to 2 week setup, flow absorption, retests, breakouts, and squeezes? Or are you watching it as part of a broader macro allocation shift? Currency stress, reserve diversification, supply constraints, and institutional behavior? Both are valid lenses. But mixing them without a plan is how you get shaken out at the worst possible moment. If you're still here, you're already doing something most people don't. You're watching mechanisms, not just headlines. You're watching who is forced, not who is loud. And that is the difference between getting tossed around by this tape and actually using it as information. Over the next week, keep your eyes on those key zones. Watch how the market behaves when it should be weak because mechanical flows are hitting, and pay attention to what happens when that pressure fades. Because that's when the market stops acting and starts revealing. And if you want to stay sharp with people who watch the same signals, the curve, the flows, the calendar, the levels, the behavior under stress, stick around, not for hype, for process, for clarity, for the kind of thinking that doesn't get bullied by a red candle or seduced by a green one. Because the move isn't just in the price. The move is in the structure. And once you see it, you can't unsee it.